The next topic which we have, or the last topic which we have for today, is IS 8. The name of the accounting standard is Accounting Policies, Change in Accounting Estimates and Errors. So there are three things in this case. Number one, accounting policies. Number two, estimates. And number three, errors. Now errors, which errors? Prior period items. Now when we talk about the first thing, what is accounting policy? So basically it's rules, principles, guidance, right, conventions, etc. So all these collectively we can say these are nothing but the accounting policies. Where we get these rules, principles, guidance and everything? Accounting standard, or any laws around the industry. All those things collectively make the accounting policies. Now what is estimate? What is estimate then? Assumption, exactly. Or judgments. So basically where these come from? Management, judgments many a times. Now what would be the error? Error is nothing but we are talking about previous year misstatements or anything which you call, right? These three things which we are going to discuss here. Provision for slow moving things is always an estimate. Why? Because we are making judgment whether how many we will be able to sell, or whether we will be able to sell it or not, or what would be the expected price we can get from the market. Okay. Now thing is, accounting policy, when we talk about, from where we get the accounting policy? Most of the times from accounting standard, right? So accounting policies, right? So I'll just move to this. Accounting policies are generally be considered or found from the accounting standard. But what happens if we don't have accounting standard which is relevant for that item? For example, let's say I take one example here. If you have made the investment in gold, there is no specific guidance that how we are going to treat that. For example, if you have invested in gold, the gold price was 10,000 rupees, now the gold price is 30,000 rupees. How to take the difference between these items or the value? Where should it go? There is no accounting guidance available anywhere. There is a guidance for investment property where we talk about if you have invested in land and if land value goes up or down, how to record that. There is a guidance for investment in shares or mutual funds, but there is no guidance on investment in gold. Now there is no accounting standard which talks about it. If there is no accounting standard, how you are, or what should be the policy? There is no guidance note also. When I talk about accounting standard, it means either it will be accounting standard or the IFRIC, which is the interpretation committee, IFRIC, which we remember the interpretation, the guidance note that is available. But if the guidance note, accounting standard, both are not available, then what would you do? You apply IS 8 for sure. But what we are going to do? we are going to generate our own policy. Now there is a flow which we follow to generate our own policy. The first thing, check, do we have any similar item where IFRS is available? Now my question or my point was that can we apply standard which we are applying to investment property? Can we apply standard which we are applying to the investment in shares, to the investment in gold which we are looking at here? Can we apply that policy, or can we have a similar IFRS which talks about this? If yes, try to get the analogy from there, right? If similar IFRS is available. If similar IFRS is not available, then what? Then IFRS says check framework. Now what is framework? Framework is actually the guidance which talks about what is asset, what is liability, what is income, what is expense, and how you should value historical cost, fair value and everything. It says try to develop policy from framework. First, try to check is there any similar standard which is available. Apply that. If that is not available, try to make a policy from framework. If that is also not possible, you are not clear whether it should be income, expense, what it should be, or where the value should be taken. The third thing talks about follow other gaps. If something is not available in IFRS, you can check US GAAP. US GAAP may give you the answer. If that is also not available, then follow industry practice. See what your competitors are doing, see what your industry is doing, and try to follow that. But you cannot go directly to the industry practice. First of all, you have to follow this particular flow. So this is something which we have discussed. Now what happens if there is a change in the accounting policy? But before that change, let's understand why would you change your accounting policy? Why would you change your accounting policy? For better presentation? Or change in law? Or required by IFRS, which says new standard has come up? So if I talk about this, if there is a change in law, or if there is a change in, or if there is a new standard come up, these kind of changes are known as, I have to change it. These are known as mandatory change. Whereas for better presentation, I can say it is a voluntary change. Either I will change because it is mandatory, new standard has come up, I cannot do anything. If IFRS 16 has come up, which is the new lease accounting standard, the older lease accounting standard, which was IS 17, will not be applicable going forward. That is the mandatory change. Or if I want to change the method of inventory valuation, that is a voluntary change because that is the option available to me. What we do in case of mandatory change and what we do in case of voluntary change, whenever there is a mandatory change, new accounting standard come up. New accounting standard always comes with right. New accounting standard always comes with transition provision. What does it mean? For example, let's say we were having earlier standard which says leases, IAS 17. Now we have new accounting standard on IFRS 16. Now what will we be doing with the older standard? Let's assume we were having X contract which was on lease. What we are going to do? We are going to follow the same thing which has been prescribed by the IFRS 16. IFRS 16 has said it is your choice whether you want to go back or you don't want to go back, what to do, where the difference should go. That everything has been guided by the IFRS 16. It says follow the transition provision or follow what new standard is saying. Whenever there is a mandatory change. But whenever there is a voluntary change, what do you need to do? You need to follow retrospectively the impact to the I'll take the numbers here for the voluntary change. Mandatory change, you don't need to do anything. Follow what standard is saying, the new standard is saying. But in voluntary change, you cannot do anything. You need to follow what? Or you need to follow the retrospective approach. So let's take up an example. XYZ has a balance sheet. Let's assume this one. Right, and they are making P&L also. So this is balance sheet, this is P&L. Right, so let's assume we have revenue of 100, cost of sale minus 90, profit is 10. On the other side, if I just go assets, let's assume I just have inventory. On the other side, we have equity, which says retained earning. So my last year retained earning was, this is for 19-20, this is for 18-19. Now whenever we change the accounting policy, right, what happens? We create a third balance sheet. Now this is third balance sheet only, we do not create third P&L. We just create third balance sheet of 1st April 18. Which is the opening of the previous year presented. Whereas on the other side we have P&L for 19-20 and 18-19. So we have both the years the profit of 10. right? Profit of 10. Now the question is, let's assume we are following FIFO method and the inventory value this year and the previous year was 100. But this year company has decided a voluntary change that they want to follow the weighted average method. When they applied weighted average method, they found the inventory value has come down to 90 this year from 100. Now let's assume you are looking at the financials at the first time. What will happen if you look at that why the inventory value has come from 100 to 90? You may feel that the company has faced a loss of 10 because nothing has changed. Nothing has happened. This year only you have changed the accounting policy. Because of that, the inventory value has come from 100 to 90. And people who do not understand the concept, they would say that there is a loss of 10. Now my question is there any loss of 10 in this particular case? Is there any loss? This is not a loss at all. This is just a change in accounting policy. Now how to show that there is no loss? Or how to show that nothing has changed? To show nothing has changed, I will not apply the weighted average method to current year, but I'll apply the weighted average method to the previous year also, and found that the previous year value is also restated to 90. Means I will apply the weighted average method. Here I am taking the same numbers, that is the reason it is the same. Now I can say the person who will look at my financials will find that there is no loss at all. But because of these, what will happen? If my closing inventory comes to 90, my cost of sale would get increased by 10. It means the profit figure which was 10 here will become 0. So my retained earning, which let's assume was 30 here, 20 here, would be reduced by 10. But to show the same impact, to show the impact that this impact is not coming this year or this impact is not coming this year, we will show or we will create the impact for the previous year also, which is, let's assume here also it was FIFO and it was 100. So let's take the impact there also, and the impact of profitability here will come in the retained earning at this point in time, which is minus 10. So we are trying to say that this retained earning which we have got now, or the loss which we are getting now, is not the loss. It is coming from the previous years only. We have just changed the accounting policy. We are just trying to take the impact of the accounting policy on year. So what it shows? It shows that we are not just going to adjust the accounting policy in this case or in this year. We will take the impact in the previous year and to the previous year also, which is the third balance sheet would be created. That's what happens when you change your accounting policy. Right? So we have already discussed the example. What happens in this case we have already discussed. What are the disclosure requirements? What is the change in accounting policy? Reason for change? What is the amount which is going to get impacted? All those things have to be disclosed.